Today, if you trade stocks using secret information before the public knows it, you're breaking the law. It's called insider trading. But what if I told you that for over a century, it was completely legal in the United States? Insider trading wasn't just overlooked, it was part of the game. In this video, we'll uncover why insider trading was legal, what changed in 1934, and how one law transformed the future of American finance. What is insider trading? Insider trading happens when someone buys or sells stock based on non public material information, things that can seriously impact stock prices but aren't known to the public yet. For example, a CEO learns their company is about to post massive losses. If they sell their shares before the news becomes public, they avoid losing money. That's insider trading. It creates an unfair playing field. One side has inside knowledge, the other is left. In the early 20th century, there were no laws against insider trading. Company executives, board members, even bankers all routinely traded stocks using secret info. It was viewed as a natural advantage of being at the top. There were no requirements to share financial reports, no system to enforce honesty, and no laws saying what was fair. The 1920s stock market boomed, but it was a fragile bubble, propped up by hype and insider manipulation. Then, in October 1929, the crash hit. Stocks collapsed, people panicked, banks failed, millions lost their savings. Investigations revealed that many executives sold their stock before the crash. They saw it coming and quietly bailed. The public left holding worthless investments. The crash exposed deep flaws in the financial system. Congressional hearings showed a market full of corruption, deception, and zero accountability. President Franklin D. Roosevelt called for reform. In 1933 and 1934, new legislation was introduced to restore trust and bring order to the chaos. The result was the Securities Exchange Act of 1934, the first federal law that regulated how stocks could be traded. For the first time, insider trading was declared illegal. The act also created the Securities and Exchange Commission, the SEC. The SEC was given the power to regulate stock exchanges, enforce securities laws, and protect investors from fraud. Public companies were now required to file accurate financial statements, disclose important information, and operate transparently. The SEC became Wall Street's watchdog. It monitors markets for suspicious activity, investigates insider trading and fraud, and enforces financial laws. It reviews company filings, holds public companies accountable, and prosecutes violations. Since its creation, the SEC has investigated thousands of cases and helped restore stability to the U.S. financial system. While no system is perfect, the SEC laid the foundation for modern financial regulation. The Securities Exchange Act of 1934 brought transparency, fairness, and accountability to American markets. It helped stabilize the economy after the crash, built confidence in investing, and continues to shape how the market functions today. Thanks to this law, all investors, not just insiders, have access to the same public information. Insider trading may have once been legal, but history showed us why rules matter. The 1934 Act was a turning point and a reminder that a fair system benefits everyone. Thanks for watching. Don't forget to like, share, and subscribe for more videos that explain how history, money,
and law shape the world around